Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
Today, we're digging into something really fundamental for anyone watching corporations, how the fear of getting sued actually changes what managers do. Not just their accounting tricks, but their real operational decisions.
That's right. We're looking at a really influential paper from 2020 by Huang, Roychowdhury, and Sletten. It's called "Does Litigation Deter or Encourage Real Earnings Management?" And it tackles a huge problem in this kind of research.
Which is?
Well, figuring out cause and effect. Do risky companies get sued more, or does the threat of lawsuits actually make companies less risky in their operations? It's tricky, but this paper uses a clever trick, a kind of natural experiment.
The exogenous shock idea.
Exactly.
Yeah.
An unexpected court ruling back in 1999 that suddenly changed the rules of the game for a whole bunch of companies in one specific region. Lowered their lawsuit risk overnight, basically.
Okay, so our mission today, we're going to break this down for you, our listeners. We'll unpack the research question, the method they used, what they found, those causal findings, and really explore what it means when that external legal pressure eases up. What happens inside the company?
Precisely. You'll get a clear picture of how they established that causal link, which is often missing, and you'll see the very real costs that can come with dialing back legal scrutiny. It's fascinating stuff.
Absolutely. Let's jump right in. We'll start with the basics. A quick summary of the paper, find some key terms you need to know, and talk about why this particular setup, this methodology, is such a big deal. Okay, so let's lay out the core question first. It sounds simple, but it's not obvious. Does the threat of being sued push managers away from manipulating their real operations, things like cutting R&D or stuffing sales channels, or does it maybe, counterintuitively, encourage it?
Right, that's the tension. The paper really dives into this. The authors, they lean towards the idea that litigation should generally deter bad behavior, right? Opportunism.
Makes sense.
So, to test this, they needed a clean setup. And they found one with this court case in Silicon Graphics, Inc., decided on July 2nd, 1999, by the Ninth Circuit Court. This wasn't some minor tweak. It significantly raised the bar for plaintiffs wanting to sue companies for securities fraud.
How so? What changed?
They introduced a much tougher standard. Plaintiffs now had to show deliberate recklessness by the executives. Before, it was often a lower bar. This change made it much harder and therefore less likely for lawsuits to succeed, effectively reducing the litigation risk.
And crucially, this only applied to companies headquartered in the Ninth Circuit's geography, right? California, Washington, Arizona, those states.
Exactly. That geographical boundary is key. It created a natural treatment group, the Ninth Circuit firms, and a control group firms headquartered everywhere else in the U.S. This setup allows for what's called a difference in differences test, or DIDI. You compare the change in behavior of the treated firms after the ruling to the change in behavior of the control firms over the same period.
So what happened? When the legal threat dropped for those Ninth Circuit firms, how did their operational behavior change compared to everyone else?
The results were pretty stark. They found a significant increase in real earnings management, RM, among those Ninth Circuit firms relative to the controls.
Wow. So less threat of lawsuits led directly to more manipulation of real business activities.
That's the main takeaway. The paper strongly concludes that litigation risk acts as a real deterrent. When you reduce that risk, managers seem to feel, freer to engage in these potentially harmful, short-term focused actions.
Okay, let's drill down into the how. Because the paper's real insight, as I understand it, isn't just that litigation stops RM directly, but it's about the communication, the disclosures around it.
Precisely. This is where it gets really interesting and connects operations to essentially marketing and external communications.
Yeah.
Think about REM actions like producing way too much inventory or slashing R&D budgets. These aren't usually good long-term moves.
Right, they often hurt the company down the road.
So to make these moves palatable to investors, to analysts, managers often have to spin a story. They need to issue optimistic statements. We're overproducing because demand is about to explode, or we're cutting costs to become lean and efficient when maybe they're just gutting future growth.
Misleading disclosures, basically, the cover story.
Exactly. Now, here's the link. If the risk of being sued for misleading statements is high, the company's lawyers are going to be very cautious. They'll likely push back against overly rosy forecasts or aggressive justifications. They'll say, "We can't claim demand is booming if our internal forecasts don't support it." That's lawsuit bait if things go south.
So by making it harder to put out the misleading disclosure, the high litigation risk indirectly makes it harder to justify doing the problematic real action in the first place.
You've got it. The constraint isn't necessarily on the operational decision itself, but on the ability to publicly defend that decision in a misleading way. Without the cover story, the RAIM action itself becomes too risky or difficult to pull off internally.
So for our practitioner listeners, the big insight is this. Tinkering with external governance, like lowering the bar for lawsuits, isn't free. It can directly lead to an uptick in managers taking short-sighted actions and being less truthful in their communications about those actions.
It highlights a real trade-off. Reducing the burden of litigation might seem good, but it can unleash costly, opportunistic behavior that was previously held in check.
Okay, that's clear. Let's define some key terms properly, especially for listeners who might be practitioners moving into scholarship. First up, the core concept. Real earnings management, REM.
Right. REM is fundamentally different from manipulating accounting numbers, which we call accruals management. RE involves changing actual business operations to hit short-term earnings targets. The authors focus on two main types measured using specific proxies.
What's the first one?
The first is abnormal production costs. This captures things like producing way more inventory than needed. Why? Because of how absorption costing works in accounting.
Explain that quickly.
Sure. When you produce goods, fixed manufacturing costs like factory rent get allocated to the inventory. If you produce more units than you sell, more of those fixed costs stay parked in inventory on the balance sheet, and less flows through cost of goods sold, COGS, on the income statement for the current period.
So overproducing makes your current profit look better by lowering COGS.
Exactly. It boosts current earnings, even if you're stuck with piles of inventory you can't sell later. This measure also captures channel stuffing, pushing excess product onto distributors with lenient payment terms, again, to book revenue early.
Sneaky. And hard to spot from the outside because the company can just claim they're optimistic about future sales. What's the second RM measure?
That's abnormal discretionary expenses. This one's maybe more intuitive. It's about managers opportunistically cutting back on expenses that are, well, discretionary in the short term, but vital long term.
Like R&D, advertising, maintenance.
Precisely those. Slashing the R&D budget saves money now and boosts current profits, but it obviously damages the company's future innovation and competitiveness. Same with skimping on advertising or delaying essential maintenance. It's borrowing from the future to make today's numbers look good.
And I think you mentioned they sometimes reverse the sign on this measure in this study.
Yes, that's important for interpreting their results. They often scale and reverse text pluses so that a higher value actually means more expense cutting, i.e. more REM. So when we see a positive coefficient on this variable in their regressions, it signals an increase in this type of manipulation.
Got it. Now, briefly contrast REM with its cousin accruals management.
Okay. Accruals management is the classic accounting manipulation. It doesn't involve changing real operations. It's about tweaking accounting estimates and judgments. Things like adjusting the allowance for doubtful accounts, changing depreciation schedules, or estimating warranty costs. It happens purely on paper.
And the literature suggests managers see these as alternatives.
Absolutely. There's a lot of evidence that REM and accruals management are substitutes. If regulators crack down hard on accounting fraud, making accruals manipulation riskier, think Sarbanes-Oxley, for example, managers who are still pressured to hit targets might shift their focus towards REM because it's often seen as harder to detect and potentially shielded by the business judgment rule.
Which brings us back to the final key term, the exogenous shock. Why is the Ninth Circuit ruling so critical methodologically?
It's the linchpin for claiming causality. An exogenous shock is an event that comes from outside the system, affecting the subjects, in this case firms, in a way that's unrelated to their own characteristics or choices. The Silicon Graphics ruling fits this perfectly.
How so?
Well, first, it was largely unanticipated. It wasn't the result of lobbying or predictable legal trends. It came from a specific judicial panel's interpretation. Second, its impact was geographically defined. Only Ninth Circuit firms were affected. This creates that clean treatment control group setup we discussed.
So it wasn't that Ninth Circuit firms were already behaving differently or expecting this.
The evidence suggests not. The ruling created a sudden, sharp discontinuity in the legal environment for one group and not the other. This allows the researchers to isolate the impact of that specific change in litigation risk, filtering out all the other noise and potential confounding factors. It lets them move beyond simple correlation to making a credible causal claim, which is the gold standard in this kind of research.
Okay, let's formally pose our first big question now. We've touched on it, but let's state it clearly. What is the research question and why is it important? The question being, does litigation deter or encourage REM? Why wasn't the answer just obviously deterrence?
Right, the ex-ante ambiguity is really key here. You had competing theories. On one hand, the argument for deterrence seems intuitive. Litigation is costly settlements, legal fees, reputation damage. Managers want to avoid that, since REM often requires those iffy disclosures we talked about.
The misleading ones.
Exactly, the ones that could get you sued. So the threat of lawsuits related to those disclosures should make managers think twice about doing the REM in the first place. High litigation risk indirectly chills the operational manipulation. That's the deterrence story.
Makes perfect sense. So what's the counter argument? The argument for encouragement.
This comes from the substitution idea we mentioned earlier. Imagine the legal environment gets tougher, but mostly focused on accounting fraud, on accruals manipulation. If managers still feel pressure to hit earnings targets, but manipulating accruals becomes too dangerous.
They might shift their focus to REM.
Precisely. They might think, okay, cooking the books with accounting tricks is too risky now, but maybe cutting R&D or stuffing the channel is safer. Why safer? Because REM often falls under the umbrella of the business judgment rule. It's harder for courts to second-guess operational decisions compared to clear accounting violations.
So under this theory, higher litigation risk, specifically around accruals, could paradoxically lead to more REM as managers substitute towards the relatively less litigated option.
Exactly. If that substitution effect was the dominant force, then you'd expect a negative relationship between general litigation risk and REM. When the Ninth Circuit ruling reduced litigation risk, if substitution dominated, maybe we'd have seen REM decrease as managers felt safer, going back to accruals manipulation.
Okay, so you have these two plausible competing effects. Deterrence versus substitution. That makes the empirical question vital, which one actually wins out in practice.
Correct. The authors set up their primary hypothesis, H1, as the null hypothesis, that REM in Ninth Circuit firms did not change relative to others following the ruling. Finding a significant effect would then support either deterrence if REM increased or substitution if REM decreased, though that wasn't the main focus.
Given this setup, why is nailing down this answer so important for, say, regulators, investors, or board members?
It's crucial for a couple of big reasons. First, REM itself is a major concern. As we discussed, it's often more damaging long-term than accruals management. It involves tangible destruction of value-cutting R&D, hurts innovation. Overproduction leads to write-offs and inefficient operations. And crucially, it's harder for outsiders to spot.
More opaque.
Much more opaque. And studies consistently link higher REM to worse future performance and stock returns. So understanding what drives it, what constrains it, is incredibly important for protecting long-term firm value.
And the second reason for its importance?
It relates to the scope and effectiveness of governance mechanisms. We know litigation is a potentially powerful tool for shareholder discipline, but there was always this question mark. Does its power extend beyond clear financial misstatements into the murkier territory of operational decisions? Decisions that managers can often defend as just running the business.
The business judgment rule shield.
Exactly. This study directly tests whether the threat of litigation pierces that shield. Does it actually discipline managers' real operational choices? Finding that it does, that reducing litigation risk leads to more REM, tells us that litigation is a far-reaching governance force, influencing day-to-day managerial discretion in ways that maybe weren't fully appreciated before. It fills a critical gap in our understanding of how external legal threats shape internal corporate behavior.
Let's move to our second question. What theories do the authors rely upon to develop their hypotheses? We've touched on them, but let's formalize it. You mentioned the deterrence mechanism and agency theory.
Yes, those are the two main pillars. The primary mechanism they test is the deterrence mechanism of litigation, specifically focusing on how it constrains the disclosures associated with REM.
Okay, flesh that out a bit more. What specific aspect of litigation cost are we talking about? Is it just the potential settlement amount?
It's much broader than just the settlement check, though that can be huge. The theory considers the expected cost, which includes monetary settlements, yes, but also massive legal fees, the huge distraction of management time and resources, damage to the firm's reputation, potential loss of investor confidence, and even personal career consequences for the executives involved.
A whole bundle of negative outcomes.
Right. And the key theoretical link the paper makes is that these costs are most strongly tied to the misleading statements managers often need to issue to justify or cover up opportunistic REM. The act of overproducing isn't directly illegal in the same way as falsifying a balance sheet, but lying about why you're overproducing, especially if that leads investors to make bad decisions, is potentially securities fraud.
So the theory posits that the fear of being sued over the cover story is what stops the action.
That's the core idea. The paper points to real-world examples. They mention several high-profile class action lawsuits where evidence of REM, like channel stuffing at Coca-Cola or aggressive cost-cutting at Hospira, formed a crucial part of the plaintiff's case. The lawsuits weren't just about the actions themselves, but about how management communicated those actions and their implications to the market.
They use the REM evidence to show that the optimistic statements made alongside it must have been knowingly false or reckless.
Precisely. The REM actions provided the physical evidence demonstrating scienter, the state of mind, the intent required to prove securities fraud. Seeing these kinds of lawsuits succeed, or even just be filed and generate negative publicity, creates a powerful deterrent. Managers and their lawyers become wary of making overly optimistic claims if they know they're engaging in potentially unsustainable operational practices underneath.
Okay, that clarifies the deterrence mechanism through the disclosure link.
Oh.
Now, how does agency theory fit into their hypothesis development?
Agency theory provides the underlying motivation, the classic agency problem, right? Managers, agents, might have incentives that diverge from the long-term interests of shareholders. Principles. They might be focused on hitting quarterly targets to maximize their bonus, boosting the stock price short-term before exercising options, or simply protecting their jobs.
Short-term opportunism.
Exactly. Agency theory predicts that managers are more likely to engage in such opportunistic behavior, like value-destroying REM, when their personal incentives to do so are high, and when the governance systems meant to control them are weak.
So the authors use this framework to predict when the effect of reduced litigation risk should be strongest.
Yes. If the deterrence effect of litigation is primarily about stopping opportunistic REM, then removing that deterrent, via the Ninth Circuit ruling, should lead to the biggest jump in REM under specific conditions predicted by agency theory.
Such as
when managers have strong incentives to manage earnings upwards. The study specifically looks at firms that are trying to meet or just barely beat analyst forecasts the tech's narrow beat situation. That's when the pressure is arguably highest to find any way to nudge earnings over the line.
And also when managers might personally profit.
Right. They also examine opportunistic insider selling, text insider net sell. If managers engage in unusually high levels of selling their own company stock shortly after announcing earnings that might have been boosted by REM, it suggests their motives might be self-serving rather than focused on long-term value. The hypothesis is that the REM increase post-ruling will be concentrated in these high-incentive firms.
And the flip side is weak governance.
Correct. Agency theory also suggests that strong corporate governance, like vigilant boards or active institutional investors, should constrain managerial opportunism. Therefore, the external discipline provided by litigation risk should be most important when these internal mechanisms are weak.
How do they measure weak governance?
They used common measures like the Gompers, Ishii, and Metric E Index, Entrenchment Index, where higher scores indicate weaker shareholder rights and more entrenched management. They also looked at institutional ownership, IO, particularly ownership by institutions known to be active monitors, like dedicated or quasi-indexing investors. The prediction is that the increase in REM after the ruling will be significantly larger in firms with high entrenchment and low institutional monitoring.
So by testing these interactions, they're not just asking if litigation deters REM, but why? Disclosure link. And when, high incentives, weak governance, grounding their empirical tests firmly in established theory.
Exactly. It adds layers of depth to the analysis, moving beyond just the main effect.
All right, let's get into the nuts and bolts with question 3. How does the research design address validity construct, internal statistical conclusion, external as well as non-random assignment, and lack of exogeneity? This is where the paper really shines methodologically.
It absolutely does. The core design, as we've established, is the difference in differences. This is powerful specifically because it's designed to tackle non-random assignment and potential lack of exogeneity in observational studies.
Remind us how Deter helps with that.
Well, you're not just comparing Ninth Circuit firms to non-Ninth Circuit firms after the ruling. That would be problematic, as those groups might differ for many reasons. Instead, you compare the change in REM for Ninth Circuit firms before versus after the ruling to the change for non-Ninth Circuit firms over the same period.
So it differences out any pre-existing stable differences between the groups.
Exactly. And by focusing on the change around an event that was arguably exogenous, the unanticipated court ruling, it helps isolate the causal impact of that specific event. The ruling wasn't driven by the firm's behavior, it was imposed on them based purely on their headquarters location. That gets us closer to the kind of random assignment you'd see in a true experiment.
What evidence supports the claim that the ruling was truly unanticipated and exogenous? You mentioned the judicial panel.
Right. The specific panel of judges assigned to the Silicon Graphics appeal was effectively random. There wasn't a clear political or economic trend leading up to it that firms could have predicted or reacted to beforehand. The authors checked news archives and legal analyses from the time, finding little evidence of anticipation. This strengthens the claim that the ruling itself is a clean shock, not influenced by the variables it's supposed to affect.
Okay, that addresses exogeneity. Now let's talk internal validity. This is about whether the observed effect, more REM in Ninth Circuit, was truly caused by the ruling or by something else happening at the same time. The big threat in DD is the parallel trends assumption.
This is absolutely critical for Diddy. The whole logic relies on the assumption that, in the absence of the ruling, the REM trends for Ninth Circuit firms and non-Ninth Circuit firms would have continued in parallel. If they were already diverging before the ruling for some other reason, then the post-ruling difference might just be a continuation of that trend, not a result of the ruling itself.
So how did they test this crucial assumption?
They did it rigorously. First, visually. They plotted the average REM levels for both groups for several years before 1999, Figure 1 Panel A in the paper. The graph clearly shows the two lines tracking each other very closely, moving almost in lockstep. There's no visible divergence before the third quarter of 1999.
The trends looked parallel beforehand.
Yes, and they backed this up statistically, performing tests to confirm that there were no significant differences in the trends of REM between the two groups in the pre-period. Finding parallel pre-trends is considered the gold standard for validating a Diddy analysis. It gives you confidence that the divergence you see after the shock is indeed due to the shock itself.
Excellent. Now, construct validity. Are they measuring what they think they're measuring? How do we know Tech-Step Pride and Tech-Step Dis really capture opportunistic, value-destroying REM, and not just normal business fluctuations or perhaps even smart operational adjustment?
That's a fair question. The authors address this by linking their REM measures to future performance. In supplementary tests, they showed that higher levels of their REM proxies, Tech-Stab and Prod, and the combined measure Tech-Stab and Prod were significantly associated with worse future operating performance, like lower future ROA, and the lower subsequent stock returns.
So the stuff they're calling REM actually predicts bad outcomes later on.
Correct. This helps validate that the measures are capturing activities that are, on average, detrimental to long-term value, consistent with the idea of myopic opportunism rather than benign operational choices. It strengthens the interpretation that the increase they observed was indeed an increase in potentially harmful behavior.
What about statistical conclusion validity? Making sure the statistical tests are appropriate and the results are reliable.
They use standard, robust regression techniques. As we'll discuss more with the econometrics, they include firm and year fixed effects, control for other known determinants of earnings management, and crucially, they cluster their standard errors.
Why is clustering important here?
Clustering standard errors, usually at the state or industry level, accounts for the fact that observations within the same state or industry might not be truly independent. Firms in the same state face similar local economic conditions and legal nuances beyond the circuit court ruling. Clustering adjusts the standard errors upwards, making the significance tests more conservative and reliable. They cluster by state of headquarters.
Okay, finally, external validity. Does this finding generalize beyond this specific 1999 Ninth Circuit securities litigation context? Could it be just a weird one-off event?
That's always a concern with studies based on a single shock. To bolster external validity, the authors performed a really important additional analysis, though it wasn't in the main tables. They looked at a completely different type of legal change: the staggered adoption of universal demand, UD laws, across various U.S. states over a longer period, 1989-2005.
And what do UD laws do?
They make it harder for shareholders to initiate derivative lawsuits brought on behalf of the company, often against its own directors or officers for breach of fiduciary duty. Like the Ninth Circuit ruling, passing a UD law reduces a specific type of litigation risk for firms headquartered in that state.
So Different type of lawsuit, different states, different time periods.
Exactly. And they found the same pattern. When states adopted UD laws, reducing derivative suit risk, firms headquartered in those states showed a significant increase in REM compared to firms in states without UD laws at that time.
Wow. Finding the same result in a totally different setting really strengthens the argument.
It does. It suggests the core principle that reduced litigation risk leads to increased REM isn't just an artifact of the Ninth Circuit case, but a more generalizable phenomenon across different types of legal constraints. It significantly boosts the external validity of their main conclusion.
Let's dive deeper into the machinery now with question 4. What econometric methods are employed, and how do they address weaknesses in the design? We know the core is a D with fixed effects, but what else did they do to ensure the results were robust?
Right, the baseline model itself is quite strong. It's typically an ordinary least squares, OLS regression, predicting and REM measure, with dummy variables for being in the Ninth Circuit, being in the post-ruling period, and critically, the interaction term. Text post-Ninth Circuit in 1 sec. And as you said, it includes firm fixed effects, FE-TO, and year fixed effects, year FE.
Let's just reiterate why those fixed effects are so powerful in this context. Firm FE.
Firm fixed effects are essential for controlling for any unobserved time-invariant characteristics of a firm. Think about things like a company's fundamental business model, its established corporate culture regarding risk or ethics, its industry, its geographic location advantages beyond just the circuit, management quality that's stable over time. Anything that makes firm A consistently different from firm B, but doesn't change much year to year.
So it wipes out those stable differences, letting you focus purely on the change within firms over time relative to the control group.
Precisely. It means we're not worried that, say, California firms are just inherently more prone to REM than New York firms for some cultural reason. Firm FE controls for that baseline difference.
And year fixed effects.
Year fixed effects do the same thing, but for time trends that affect all firms nationally. Think about macroeconomic swings, booms, recessions, changes in overall investor sentiment, major regulatory changes that apply countrywide, like shifts in gap, or even specific events like the dot-com bubble burst around 2001. Year FE absorbed the average impact of these economy-wide factors in each year.
So, by including both firm SE and year FE, the model really isolates the variation that's specific to the Ninth Circuit firms after the ruling, controlling for both stable firm differences and common time trends.
Exactly. It's a very effective way to mitigate omitted variable bias in panel data. And as we noted, they cluster standard errors by state to handle potential correlations within states.
Okay, that's the baseline. But good research always pushes further. What methods did they use to address potential remaining weaknesses or endogeneity concerns? You mentioned propensity score matching, PSM, earlier.
Yes, PSM is a key robustness check. Even with DID, there's a potential concern that the Ninth Circuit firms might have been trending differently just before the ruling due to some unobserved factor, or that they differed systematically on observable characteristics in ways that might influence their response to the ruling, even if the pre-trends look parallel on average.
So PSM tries to create a better comparison group.
Exactly. What they did was, for each Ninth Circuit firm, the treated group, they found one or more firms from the control group that looked extremely similar based on a whole range of observable characteristics in 1998, the year right before the ruling. These characteristics included things like profitability, ROA, size, leverage, market-to-book ratio, industry, and even pre-existing levels of REM and accruals management.
So they build a synthetic control group that's almost identical to the treatment group just before the shock.
That's the goal. The propensity score is essentially the predicted probability of a firm being in the Ninth Circuit based on these 1998 characteristics. They matched treated firms to control firms with very similar propensity scores. Then they rerun the main debt analysis using only the smaller matched sample.
And the result?
The results held. They still found a significant positive coefficient on the text Ninth Circuit interaction term, reported in Table 5. This provides strong assurance that the main finding wasn't just driven by comparing inherently different groups of firms, but reflects a genuine response to the change in legal risk among comparable firms.
Very convincing. What about those geographical controls you mentioned? How did that work econometrically?
This was another clever check to rule out alternative explanations, like maybe something unique was happening economically only in the Ninth Circuit states around that time. They restricted the analysis to a sample of firms located physically close to the Ninth Circuit state borders.
So comparing a firm just inside California to one just outside in Nevada or Arizona.
Right. The idea is that firms operating very close to each other, but on opposite sides of a state line that also happens to be the circuit boundary, should face very similar local economic conditions, labor markets, supply chains, etc. The primary difference between them is the legal jurisdiction determined by the Ninth Circuit ruling.
And did the effect hold up in this border sample?
Yes. They found the significant increase in REM was concentrated in the firms located inside the Ninth Circuit boundary within this narrow geographic band. Firms just outside the border didn't show the same increase. This strongly suggests the effect is tied to the legal change associated with the circuit court, not some broader, unobserved, regional economic factor that happened to coincide with the ruling.
That really pins it down geographically. Finally, how did they address the potential substitution between REM and accruals management econometrically?
They tackled this in a couple of ways. First, in their main regression models predicting REM, they always included the measure of abnormal accruals as a control variable. This means the estimated effect of the Ninth Circuit ruling on REM is incremental to any simultaneous changes in accruals management.
So the REM increase wasn't just an artifact of firms doing less accruals management.
Correct. The coefficient on Textine circuit remains significant even when controlling for hat-stick stock. Second, they did perform specific tests looking at the relationship between changes in REM and changes in accruals after the ruling, Table 9. They found evidence consistent with substitution firms that increase REM the most tended to have smaller increases or even decreases in accruals management and vice versa. But the key point is that the main DID result for REM holds even after accounting for accruals.
So while substitution might be happening for some firms, the overall effect of reduced litigation risk was a net increase in REM, controlling for accrual changes.
That's what the evidence points to. The econometric methods employed are really quite comprehensive in addressing the potential weaknesses and alternative explanations inherent in this type of research.
Okay, we've covered the setup, theory, and methods. Now for the payoff with question 5. What are the major results, and do they definitively answer the research question? Did litigation deter REM?
The primary result, found consistently across their main analyses, Table 3, provides a clear answer. Yes, litigation risk appears to strongly deter REM. The key coefficient, the interaction term text post times text Ninth Circuit, is positive and highly statistically significant for all three measures of REM they used.
Just remind us what those measures were again.
They used abnormal discretionary expenses. Scaled so positive means more expense cutting. Abnormal production costs, where positive means more overproduction or channel stuffing, and a combined aggregate measure, RM, which sums the two.
And the coefficient was positive and significant for all three.
Yes, typically significant at the 1% level, p 0.01. This means that after the 1999 ruling reduced litigation risk, firms headquartered in the Ninth Circuit significantly increased their levels of expense cutting and overproduction relative to comparable firms headquartered elsewhere.
So the reduction in the threat led directly to an increase in manipulative real activities. How substantial was this increase? Was it economically meaningful?
It appears so. They report magnitudes suggesting, for example, that the increase in cutting discretionary expenses was about 10% of that measure's standard deviation. The increase in abnormal production was similarly non-trivial. While translating these statistical measures into exact dollar impacts is hard, the size of the coefficients suggests this wasn't just a minor statistical blip, but represented a real, noticeable shift in operational behavior for the average affected firm.
Okay, so the main answer is yes. Deterrence seems to be the dominant effect.
Yeah.
But the paper went further. Testing the mechanism, that disclosure link, what did they find there?
This is arguably one of the most important supporting findings. Table 6. They tested whether the increase in REM was more pronounced for those Ninth Circuit firms that also started using more optimistic language in their communications after the ruling.
How do they measure optimistic language?
They used established textual analysis techniques to measure the tone of management discussion and analysis MD&A sections in financial reports, the tone of earnings press releases, and also looked at whether managers issued forecasts that turned out to be overly optimistic, text optimistic forecasts.
And the results?
They found strong support for the disclosure mechanism. The increase in REM following the ruling was significantly larger for those Ninth Circuit firms that simultaneously exhibited abnormally optimistic tone in their MD&As or press releases, or issued optimistic forecasts.
So the firms doing more REM were also the ones putting out more hype, essentially.
Exactly. It strongly suggests that the reduced fear of being sued over misleading disclosures enabled managers to both engage in the REM and provide the necessary, potentially misleading, optimistic cover story for it. This finding is critical because it empirically validates the specific theoretical channel they proposed, that litigation deters REM primarily by constraining the associated disclosures.
Powerful confirmation of the mechanism. Now, what about the tests related to agency theory, the role of incentives and opportunism? Did the results align with those predictions?
They did, very clearly, Table 7. The authors tested if the YUM increase was stronger when managers had clear short-term incentives to manipulate earnings. They found the effect was significantly more pronounced in two key groups.
Which were?
First, firms that were trying to narrowly meet or beat analyst earnings forecasts. These are the firms under the most pressure to find that extra penny of earnings per share. Second, firms where managers engaged in opportunistic insider selling after the earnings announcement.
So the firms where managers stood to gain the most personally from hitting short-term targets were the ones that ramped up REM the most when the legal risk dropped.
Precisely. This provides strong evidence that the type of REM being deterred by litigation is indeed the opportunistic kind, driven by managerial self-interest, rather than potentially justifiable, albeit aggressive, business decisions. It connects the observed behavior directly to agency conflicts.
And the final piece of the puzzle, the role of internal governance. Did they find that the effect was stronger when internal controls were weaker?
Yes, mirroring the incentive results, they found strong evidence for the governance link as well. Table 8. The increase in REM post-ruling was significantly greater in firms with weaker internal governance structures. Specifically, firms with higher levels of managerial entrenchment, using the E-index, showed a larger increase in REM, and firms with lower levels of institutional ownership, particularly by those institutions known to be active monitors, also experienced a significantly larger jump in REM.
So where the board was likely less powerful, or where watchful institutional investors had less presence?
The removal of the external threat of litigation had a much bigger impact. This confirms the idea that litigation acts as a crucial external disciplinary mechanism, substituting for or complementing internal governance. When internal checks and balances are weak, the threat of a lawsuit becomes particularly important in constraining managerial opportunism.
Taken together, these results seem to paint a very coherent picture that strongly supports the author's hypotheses and answers the core research question quite definitively.
I agree. The consistency across the main effect, the mechanism tests, the incentive tests, and the governance tests builds a very compelling case.
This brings us to our final question for this deep dive. What conclusions do the authors make, and perhaps more importantly, are they warranted given the theory, design, and econometrics we've discussed?
The authors draw three primary interconnected conclusions from their findings. First, and most centrally, they conclude that litigation risk serves as a significant deterrent to real earnings management.
The main finding.
Second, they conclude that this deterrence operates primarily through the channel of constraining the optimistic or misleading disclosures that managers often need to issue alongside REM activities. The fear of being sued over the words prevents the actions.
A mechanism.
A mechanism, exactly. And third, they conclude that this deterrent effect of litigation is particularly strong when managerial incentives for opportunism are high and when internal corporate governance mechanisms are relatively weak.
The context driven by agency theory.
Right. So it's not just that litigation deters, but how and when it deters most effectively.
Okay, those are the conclusions. Now for the critical assessment. Are they warranted? Does the evidence truly support these strong claims?
In my assessment, yes, the conclusions are very strongly warranted by the evidence presented. The core strength lies in the research design itself. By leveraging the exogenous Ninth Circuit ruling within a DD framework, they managed to overcome the huge endogeneity problem that typically plagues research in this area.
The chicken and egg problem of whether litigation causes behavior or behavior attracts litigation.
Exactly. Their design provides as close to a causal identification strategy as you're likely to get with observational data in this field. The ruling was sudden, geographically specific, and unrelated to the firm's prior actions, allowing for a clean comparison.
And the extensive robustness checks we discussed add further weight.
Absolutely. The confirmation of parallel pretrends is crucial for the internal validity of the DA. The propensity score matching analysis addresses concerns about sample comparability. The geographical controls using border firms brilliantly isolates the legal effect from local economic factors. Using the universal demand law adoptions as a separate setting confirms external validity. These aren't just minor checks, they are rigorous tests that directly address the most likely threats to the validity of their conclusions.
It sounds like they really covered their bases methodologically.
They did. Furthermore, the cross-sectional findings, the results on disclosure tone, managerial incentives, and internal governance provide compelling empirical support for the theoretical mechanisms they proposed. They didn't just find an effect, they provided strong evidence for why that effect occurs and under what conditions it's most pronounced. That theoretical grounding, combined with the robust empirical design, makes their conclusions highly credible and well-warranted.
So the paper stands up to scrutiny.
I believe so. It represents a significant contribution precisely because it tackles a difficult question with a powerful and carefully implemented methodology, leading to conclusions that feel earned by the evidence.
So stepping back, this deep dive into the Huang et al. Paper really underscores the intricate connections between legal environments, corporate governance, and actual operational decisions. Seeing how a single court ruling could ripple through hundreds of companies and tangibly change things like R&D spending or inventory levels is quite striking.
It really is. It places litigation firmly within the broader governance ecosystem. It's not just something that happens after things go wrong. The threat of it acts as a powerful ex-ante deterrent, shaping behavior before problems even arise. And it highlights how litigation can step in when other mechanisms like board oversight or institutional monitoring might be lagging or ineffective.
It also strongly reinforces that theme of substitution between accruals and real earnings management. Managers facing pressure seem determined to find an outlet, and the relative riskiness of different channels driven by regulation or legal threats heavily influences their choices.
Definitely. It paints a picture of managers actively choosing between these tools based on perceived costs and benefits.
Now, we should inject a note of caution, a bit of critical thought here. While this paper clearly shows the benefit of litigation risk-deterring opportunistic REM, we need to remember it's not the whole story, right?
Absolutely. That's a crucial point. The authors themselves acknowledge this. Other research, for instance, suggests that reducing litigation risk can sometimes be beneficial. It might encourage more corporate innovation, more appropriate risk-taking, because managers aren't constantly looking over their shoulder, afraid to try something bold that might fail and lead to a lawsuit.
So, higher litigation risk might deter bad behavior like REM, but it could also potentially stifle good, value-creating risks.
Precisely. There's a trade-off. This paper masterfully isolates one side of that trade-off, the deterrent effect on opportunism. But policymakers and boards need to weigh that benefit against the potential costs of litigation chilling legitimate business activity. Finding the optimal level of litigation risk is incredibly complex.
That leads nicely into a final provocative thought for you, our listeners, to consider. The papers show the REM increase was sharpest right after the ruling in 1999. Now, other studies have suggested that over time, following such reductions in legal discipline, sometimes institutional ownership increases as the market perhaps tries to compensate with more monitoring.
The idea of governance mechanisms substituting for each other.
Right. So the question is, was that initial immediate spike in REM after the ruling proof that litigation provided a unique binding constraint that these other mechanisms, like increased institutional monitoring, were simply too slow or perhaps too costly to replace effectively in the short run? Did that initial burst of opportunism cause real lasting damage before the governance system could re-equilibrate? Or did the system adapt relatively quickly?
That's a fascinating question about the dynamics and speed of adjustment within the corporate governance landscape. It highlights the ongoing interplay between external legal forces and internal market-based monitoring. Definitely food for thought and future research.
Indeed. It shows just how complex and interconnected these forces are. Thank you for joining us for this deep dive into a really important piece of research on litigation, disclosure, and real earnings management.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.